Is there a real market impact from a potential government shutdown, as Beth Hammack just mentioned? They generally last a few days. Is there a genuine market impact that investors should be mindful of?
I think it's going to have a lot of other impacts, certainly on the data she mentioned. But, in terms of overall market impact, there have been about 7, depending on what you count, shutdowns in the last 40 years. And the market impact's typically been muted. So I think if we saw a pullback, which I kind of don't think we'll see, we'd probably be buyers of equity on a pullback.
All right, if you're looking at the futures, that doesn't seem like the market's very concerned about it.
Today, no.
At least not right now. You look at the S&P up about 0.5%, the NASDAQ even higher than that. I want to go back to the economic release part of it, though. We have a guest coming up who believes there's about a 70% chance of a shutdown. Now, the question is, does that impact the jobs report and other upcoming reports? Let's say it does. Does that, in your mind, change the ability of the Fed to make a clear decision in their upcoming meeting? And does the market, does it get riled a bit by the idea of questions about the Fed cutting? Because it seems all but certain right now.
It does, and I probably agree with that probability, maybe even a little higher. I think we're going to see a shutdown, and it will impact data releases. The Fed may have to look to other data sources, like ADP report that'll be coming out. And markets don't like uncertainty, and this is a particularly data-dependent time in the market. I mean, we're going to see a cut at the October meeting. Markets pricing into. The question is, do we see a third cut? And I think that's going to depend a lot on the employment data.
Wait, so you think it's a foregone conclusion that we're getting that cut in October?
I think we're getting the cut.
And the shutdown can't impact that at all in your mind? The idea of not having the Fed just not having the same clarity if we don't get those economic reports, potentially. I want to make sure we make clear to the audience it's not a definite, it's a possibility.
It's a possibility. The market certainly is pricing in a high probability. I think based on the employment data we've seen so far, we've seen jobless claims tick up a little bit, but continuing claims have been elevated, still at a relatively low absolute level. Some other factors I look at, and I'm sure the Fed looks at, would be people working part-time for economic reasons. That's ticked up the past few months. So I think there's no question. The unemployment rate, of course, is at its highest since October of 2021, coming out of the pandemic. So I think the employment backdrop is weakening, and the Fed's cognizant of that.
Let's not focus on the negative. Let's look at the positive, or what could be a positive. The possibility of a market broadening. Are you a believer that the market's actually broadening? We're going to show the chart. The S&P equal weight in the S&P since the Fed cut rates. The equal weight's doing slightly better. It's a small sample size as well. Are you a believer in the broadening, and what sectors benefit if we do see a broadening?
I do think we'll see some broadening. We still continue to like big cap tech, but I think we'll see a broadening in mid cap and small caps. Small caps in particular can be more rate sensitive, and as we see additional rate cuts, I think we will see additional rate cuts. I think small caps could continue to rally. They've outperformed, fairly recently.
All right. What about other cyclical sectors? I mean, we're going to be talking a lot about cyclical sectors coming up in earnings season. Banks report first, financials, materials, industrials. If the market's going to broaden, why not those sectors over small caps? Because the small caps, in all honesty, they seem like a bit of a catch-up trade that's already lost a lot of steam.
It is a little bit of a catch-up trade. I think the challenge with cyclicals is if we are starting to see, some modest weakness in the economy, and I think we are, you wouldn't want to be leaning into the cyclicals, the industrials, the financials in that situation.
All right. One other question for you very quickly. Just a couple days ago, Bank of America came out with the idea that 60-40 portfolio, that's a thing of the past. The 25, 25, 25, 25. Is that 4 25s? I hope so.
25. Adds up to 100.
Yeah. Stocks, short-term T-bills, bonds, longer-term bonds, like the 10-year, and then 25% gold. What do you make of that?
I think that's a lot in short-term instruments. I mean, I think people have really enjoyed, being able to, collect 430 on their T-bills over the past few years, and money market rates will come down with Fed rate cuts. So that does seem, high at the short end. To have that position in gold, you really have to be concerned about inflation. I do think there are probably other ways to hedge against inflation if that's the problem you're trying to solve. Maybe it's dollar weakness, although as you mentioned earlier, the dollar's recovered a bit. You could be in a broad, diversified portfolio of material stocks that I think would give you the same type of protection.